One of the products that banks are offering these days is a collateral charge mortgage. And the problem is most people working at the banks don't really know what it means. So if you're going to take one of these products, I want you to understand the good and the bad. So let's start with the good first. Now, the benefit to a collateral charge mortgage is that the lender registers on title, so the deed of the property essentially, more than you actually owe. So the benefit to this is that if your home goes up in value, you do renovations, if there's some reason that you need to change your mortgage a little bit, like add a line of credit, take out another second mortgage with the same lender, they can do this without triggering legal fees quite often, and more importantly, without breaking the first mortgage you already have on the property. The other benefit to a collateral charge product is that it allows you to have a readvanceable mortgage. This is a mortgage product where as you pay down the mortgage debt, it has a home equity line of credit that increases and gives you access to what you've paid down. Now, these products can be really flexible and create a safety net for you as a homeowner in case you need to fix your roof, but they can also open up investment strategies like a way to buy investment properties, to create a safety net if you do have investment properties, and also open up a tax strategy called the Smith maneuver. The things you need to know, though, about these products is there are some negatives. The first and smallest one is that at renewal, if you try to change lenders, it might cost you a couple $100s more to switch. Personally, I would say the benefits drastically outweigh that disadvantage, but it's something you should know. The next disadvantage is a big one, and that is if you have, say, a truck loan for $100,000 and it's with the same bank as your mortgage, which is a collateral charge, if you default on that truck payment, they can theoretically secure it against your home. So you need to be really careful. The most common scenario where this is reasonable is if you start a business. You have to be really careful if you're going to take a business loan with the same bank as you have your mortgage. You want to make sure you do not have a collateral charge, because if for whatever reason that business fails and maybe your corporation or your sole proprietorship has to walk away from the debt, they will be able to go after your home and foreclose on you. So very, very bad situation that you want to avoid. The easiest workaround is when you go start your own business, go get a business loan at any lender other than the bank who has your mortgage. The last defect or the last drawback to a collateral charge mortgage is the fact that these are demand loans. So it's easier for the bank at the end of your term to say, we don't want to renew you, you need to go elsewhere, pay us back. And it also gives them the ability to increase the cost of your home equity line of credit with 30 days notice. So they can minimize the limit, they can close it, or they can demand that you pay them back within 30 days. And they can also increase the rate up to 10%, usually speaking, on these home equity lines of credit. So it's very important that you treat your lender well and that you make sure you keep your payments on time. In a worst case scenario like 2008 in the US, there's a chance that they could close or call these mortgages. Overall, I personally think the benefits drastically outweigh the disadvantages, but it is important that you understand what these disadvantages are so you can make sure that you're not going to get caught in a worst case scenario. If you have any questions, my name is Keaton. I'm a mortgage broker with KB Mortgages, and our website is www.kbmortgages.ca. If there's anything I can do to help at all, just let me know.